Well, good morning and a very warm welcome to this webinar, Outlook for Corporate Hybrid Bonds, brought to you by Scope Ratings. My name's Keith Mullin and it's my pleasure to be your moderator for today's session. I'm delighted to be joined today by two analysts from Scope's Corporate Ratings team. So let me introduce you straight away to Azza, Chammem and Sebastian Zank. Azza, Sebastian, hi there, great to see you, thanks for being here.
Thank you.
So we've decided not to take you through a long presentation, but instead to keep it short and sweet and go straight into Q&A with a few slides just to help with our narrative. Azza and Sebastian will be answering questions on the issuance outlook for European corporate hybrids, the drivers of the issuance and expected breakdown, the sector breakdown. They'll also explain Scope's approach to dealing with the vital issue of equity credit for hybrids that are not called and where coupon step-ups are triggered, and any other related methodology topics. We'd like to make today's session interactive, so I do encourage you to take full advantage of the questions function on this platform to write in questions as we go along, and we'll get to them at the end. Now, of course, we've seen some extreme volatility in equity and bond markets in recent days, and as a rating agency, bit of a spoiler alert, we can't comment on market pricing or fair value, and definitely not on any potential future corporate rating actions. So with that disclaimer, let's get started. So as I said, we'll go straight into Q&A. So look, can you outline your issuance outlook for European corporate hybrids in 2025 in terms of aggregate volumes and perhaps how that compares to previous years? I just maximize this and you can take it from there.
Yes, thank you, Keith. So somehow looking at the current perspective and what drives the issuers to issue hybrid bonds, we expect somehow steady issuance volume for 2025. As of now, our year to date, so we saw an issuance volume of 6 billion somehow, and we may expect issuers to come somehow by the other second half of the year. And one of the key reasons that we see somehow muted issuance in this period of time is because of the volatility somehow of the geopolitical tensions that are reflected in the stock exchange market, but also the bond market and the hybrid, which is quite sensitive to a lot of events, let's say macroeconomic events. So,
can I just interrupt you? Look, I think you're having a problem with your sound. Could you move a bit closer to where the microphone is? Because I think you're cutting out a little bit, certainly on my screen. So apologies for interrupting.
Yes. So the issuance volume will be somehow similar to 2024. It will be driven by the upcoming refinancing. So as you can see in the graph, there was a lot of issuance or peak by 2022, and there will be first call this year for a lot of this issuance. This is the source of our confidence somehow. So there are first call dates in 2025 and 2026 that are around 70 billion, and a lot of issuers will be expected to call or replaced by another hybrid. But for sure, we will not see the same volumes that we saw back in 2022 because now the interest rate is higher. So there will be issuance for some purpose, like refinancing.
Okay, I think, can you perhaps move on to talk about some of the drivers? What's given your expectations? Can you just talk a little bit about what you expect to be pushing all of that?
Yes, as I mentioned, one of the key drivers is upcoming calls and refinancing. So as I said, there was a peak issuance back in 2022 and 2021, and a lot of issuers are expected to refinance to retain somehow the equity credit. And another reason is capital structure optimization. So some of the issuers want to keep the hybrid in their in order to benefit from the 50% equity and to maintain their leverage at a somehow good level or manageable level. And another reason is the stabilization of the rates. So the ECB may come to the end of its high interest rate or raising the interest rate or the peak of the rates. So the hybrid issuance will be more attractive because we see now that the spreads are tightening or narrowing compared to the conventional bonds, which is one of the drivers and which the issuers considers as a good environment, or comfortable environment to issue new hybrids. And as I said, so the rating agency 50% equity is important to the issuers. So this is a driving force, and they need to also show commitment to the instrument by replacing the hybrid with a new hybrid.
Okay, in terms of the how it's going to break down by sector, can we talk about that? I think it's clear that these are capital-intensive sectors, generally speaking, that are issuing hybrids. But how do you see this panning out? And perhaps we'll go and talk about some of the underlying sector issue. But let's talk about the sectors first of all.
Yes, as you can see in the graph, you see that the utilities which are green are one of the prominent issuers. So they have outstanding volume of more than 30% in the market. So we may expect them to be very active this year. So one of the reasons also is to the high capex pressure that they have. So issuing the hybrid will help them to alleviate this pressure because of the 50% equity benefit. And another sector or two sectors that we may see are telco and oil and gas that you can see in brown and orange. So both of them will be active in the market and for the purpose of refinancing. And to a lesser extent, we may see real estate companies which are here in blue in the shown graph, and we may see some issuance, but let's say to a lesser extent that we saw in the previous years because of the investor sentiment. So somehow the investors are, or the real estate sector is more stable this year, but we may see issuance from, let's say, investor grade companies, or the investors will not be very happy or very welcoming issuance from relatively weakly rated company or with high leverage because there are some concerns. And for the other sectors, it will be really sector specific or company specific, whether it's for M&A or investment or to optimize the capital structures. It's really company specific because there were some entrants to the market in the previous years, and or they need to refinance to keep benefiting from 50% equity.
Yeah. Okay, Sebastian, can I bring you in at this point? I'm very interested in the sector outlook and the sector breakdown. And I know one of your specialities is utilities, and I wonder if you can perhaps talk about what is utilities is across the board phenomenon where issuers are issuing hybrids, or are there certain types of utility or certain business models that potentially are going to drive issuance? Can you talk a bit about the underlying sector drivers here for utilities?
Yeah, thank you, Keith. That's a good question. And I think we can also pretty much comment on this. As it spoke, we cover a lot of utilities that are using hybrid debt positions for their financing. And this is certainly not because those companies like the higher coupons that they have to pay on these hybrids compared to conventional senior unsecured debt positions. So Azza somehow hinted already that some companies use these hybrid debt positions in order to preserve their credit profiles because the rating agencies are typically granting the equity credit to these positions. And that's certainly very much valid for the sector of utilities. So as shown in the graph, the utilities have already been a sector that has largely used hybrids over the last few years. And we expect that this story or that this picture will continue over the next few years. And this is strongly related to the energy transition and the related capex that these companies have to take on a continuous basis. So just imagine when you have to cover large capex programs that are biting into those companies' free operating cash flows, then you need to take some measures that preserve the credit profile. Because you can imagine that preserving the credit profile in such a heavy investment phase is quite important now that you don't benefit any longer from ultra low interest rates. So having a good or a less good rating in the very end really matters for these utilities. And actually, the usage of hybrid debt positions for utilities goes across the entire industry, because almost on all steps of the value chain, the companies need to invest a lot, be it new assets for power generation or companies that are heavily exposed to energy transmission and distribution. So in order to relieve the pressure on the balance sheet, they are continuing to replace old hybrids, or some companies are actually entering the market with an inaugural hybrid debt security, just in order to be sure that they keep the credit ratios that they need, and that they don't trigger any potential negative action from any of the rating agencies.
You're on mute.
I'm on mute. Sorry. There's been a lot of chatter and market interest in recent months and perhaps the last year around equity credit. This is a rating agency topic, and I know there's some differentiation between the rating agencies. But can you talk about Scope's position on equity credit, particularly if issuers decide not to call their hybrids? Perhaps you can run through the hybrid criteria, if you wouldn't mind.
Yeah, absolutely, Keith. So this question has come to Scope multiple times over the last few months, because we've seen that there has been a lot of uncertainty among investors, among rating advisors, and among affected companies that wanted to have the certainty how a credit rating agency would treat hybrid debt positions that would be affected by a non-call event or a step-up event for the coupon. And in order to answer this question, I'd like to draw your attention to the chart on the left-hand side on this slide, where we have outlined our criteria for the treatment of hybrid debt positions in the computation of credit metrics, and thus the reflection of these positions in our ratings overall. So when you look at the criteria, then you see that we have actually four main criteria which we need to see in order to determine whether something is a hybrid debt security or not. And here I would differentiate between something that I call the hygiene factors, which are just a normal feature that is, of course, always there for these hybrid debt securities, but that doesn't really move the needle. And this feature is related to the replacement and the contractual subordination. But more importantly, there are these two features which are at the top of the table, and these features relate to the coupon deferral and the maturity or the obligation to repay a particular instrument at a particular time. So when you think about companies that have not called their hybrids at the very first call date, We have, in the last few years, seen a number of examples. So typically it's not the case, but there are a few companies that use the right not to call at the first call date. And the companies who are using this option not to call have various reasons for doing so. So that could be the prevailing market conditions where they think that, okay, it's not the right timing to replace an outstanding hybrid debt instrument with a new one that then carries a different coupon. Or it could simply be that the companies refer to strategic financial considerations, which justifies that they are not calling the hybrid at the first call date. Or in other words, one could say that there are some liquidity constraints or a limited access to new financing, which limits the options for those companies to call at the first call date, or in some very rare events, we even see that technical issues have led companies not to call. So here we can give some examples, like recently some real estate companies that did call their hybrids when they reached the first call date, companies like Around Town, Peach Property, or Heimstaden. But there's also a very good, very prominent example of Lufthansa, the German airline, which was not in a position back in 2021 to redeem its outstanding hybrid bond in the wake of COVID. So there are such companies might use this right not to call, but does this really alter the essential features of a hybrid debt security? Scope's answer is absolutely not. And here again, I point to the 4 essential features for the classification of hybrid debt securities. And actually, I could argue in a very contrarian way that when we as a rating agency see that the company does not call, it's rather speaking for and not against the equity-like character of a debt security. Because in the very end, it is boiled down to the question, okay, is there an obligation to repay at the first call date, or is there no obligation? And for the hybrid debt securities, there is absolutely no obligation. So it's at the full discretion of the issuer to decide whether they call and redeem the hybrid or not. And I think it's a good, not maybe a strong signal to the capital market when the hybrid is not called on the first call date, but it's a good signal that the feature of the equity-like instrument is in place. Because in the very end, the companies are using this feature in order to preserve the financial flexibility, in order to retain the liquidity cushion that they might need very urgently at a particular point in time. And so there is this very strong difference to normal senior unsecured or senior secured debt positions, which have a proper maturity date, where there is no question whether you are repaying it or not at the maturity date. So when the issuer in the very end decides not to call it, no harm is caused. And we as a rating agency would absolutely continue to grant the equity credit to such debt securities, even when they are not called on the first call date, but also not on the second call date or any other call date which come thereafter. And basically, the very same answer would be given when dealing with companies that have a hybrid debt security that has a coupon reset, either a fixed coupon reset or a dynamic coupon reset, which is triggered by certain events. So also in those cases, we look at the essential features that need to be fulfilled for a hybrid debt security, and that remains the obligation to repay, and that remains the right to defer a coupon. So on that front, even when we see that a company is facing a coupon step up, for example, it would absolutely not alter these essential features. So that would also mean that in the very end, we would continue to grant the equity credit. And I think that is very important for all the market participants who need this certainty that rating agencies are just showing a continuous approach where the criteria are not changing over time. Yeah, because then the companies would be put into a very dangerous position because it could prove that their financing decisions were maybe not preserving the credit quality in the very end because they decided to put certain features into the bond documentation. And here I think Scope has quite a reliable and robust approach, which gives the certainty to everybody involved that actually until the very end, until a hybrid debt security is being redeemed, there is the very same treatment throughout the whole life of a security.
Yeah. Well, I think that's very, very clear, and I think an important distinction issues you made there. There are a couple of questions actually I just want to throw out to you that are coming from our audience about maturities, and I guess it's very apposite because we have seen the emergence of these 30-year hybrids alongside these ultra long dated and perpetual securities. So what do you consider a long-term maturity? Is there a specific floor?
Yeah, we consciously have not included a specific floor on maturity. So as long as one could argue that it's a long maturity, so I would say it's typically more than 10 or 15 years, we would consider this as a long-term maturity, which is fully enough to grant this equity credit.
Let's say that this feature somehow is helping both the investor that has somehow is able to have a more clarity about where when the company is able to pay, and also for the companies in order for them to properly manage their maturity profile. So 60 years or 30 is somehow more convenient for some companies, and appeasing also the investors' sentiment when it comes to the ability to pay back this hybrid bond at certain point.
Yeah, okay. Well, look, unless you either of you wanted to add anything to what you've already said, I've, I guess, come to the end of my question. We wanted to keep this session, as I said before, short and snappy. I guess there are market issues out there that you may want to need to attend to. I do apologise that the sound was a bit up and down over the course of the last 20 minutes. So I hope you managed to hear most of that. If there are no more comments you wanted to make, Azza or Sebastian, I suggest we close the session. We have made the slides available for download. So if you wanted to download the slides, you just click at the bottom of the screen. You'll see a button which says Apps. And if you click on that, you'll see handouts emerge. And if you click on handouts, the PDF of the slides that Azza and Sebastian went through will be available for download. So I'll leave you to do that for a second. But in the meantime, thank you so much, Azza. Thanks a lot, Sebastian, for your comments. Thanks to our viewers for dialing in and listening. If you have any further questions, don't hesitate to reach out to any of us, and we'll be more than happy to get back to you. So on that, I'll close the session, and I wish you a very successful rest of the day. Be careful out there. They're not easy markets, and we'll see you next time.
Thanks, Keith.
Thanks, Keith.
Thank you. Cheers.
Bye.